the biggest one for us is our largest fund, the Market Neutral Income Fund. It's about a $14 billion fund, with bonds once again down year to date, and we're up, 1.5%, 2%. We're up 9 last year. It fits pretty well for a lot of people.
So this is, and we're looking at some of the construction of this at the end of last year versus the year prior. You're not going to see traditional fixed income from a bond standpoint. You're creating fixed income like properties mostly through equities?
Well, mostly through half is equities, half is a hedged equity strategy where we're essentially long the S&P 500 through individual stocks, but economically we're basically long the index and trading index options on top of it, selling calls, and using a portion of that income to buy puts and a portion of it is income for the portfolio. And then the other half is arbitrage strategies, mainly convertible arbitrage, where we're buying convertible bonds and shorting their underlying stock. Names that have been big in the convertible market in the past include NVIDIA and Tesla.
And what does that mean for you? Because, correct me if I'm wrong, you're not directionally long the plays that you're arbitraging the convertible debt, but I mean, if the better they're doing, the more debt they issue, then I would guess the more opportunity you have to arbs. How does that play out?
Yeah, we're long volatility, so we want to see the stock move around. So things like the S&P 500 event are good for us. It gives us an opportunity to trade the stock. Stock goes up, we sell some to get heavier in our delta to get more in line with an economically neutral delta. And then the stock pulls back a little bit, we buy it right back. You're mechanically selling high and buying low and generating return from that. It's a lot of, we used to say singles and doubles, and we've kind of evolved to, singles and walks. But you try to have a lot of, 70, 80% of your trades be winning trades and, and earning a return over time.
What is the genesis of it? Why is it the one that you're putting most in front of investors? Are they still looking for bond replacement? Is there still an idea here that if we're in an inflationary environment, treasuries are not going to be as safe as a ballast in the portfolio?
I think it's still, fixed income's still tough, right? Rates are the yield curve doesn't look like, what I would call a normal yield curve. You think back 20 years ago and overnight money was here at 5%, but, the 5 and 10 year and 30 year were all higher than overnight money. It was a positively sloped curve. We haven't had that for a while. And, at some point, the bond market and the stock market are going to say the same things, but they haven't for a while. So I think it makes sense to think about how you diversify your fixed income allocation. It doesn't mean you're not going to own any fixed income, but at the margin, you may want to look at alternatives.